Hi, my name is Kevin. I'm a fifth-year graduate student at Caltech. I'm studying towards a PhD degree in mathematics. I've completed an internship at Morgan Stanley this summer, where I work on foreign exchange option strategies. I also work with Ken Winston, our team mentor at Winston Asset Management, where I develop a risk model for high-yield loans. I was in charge of the overall strategies.
Hi, I'm Justin, and I'm an undergraduate pursuing a computer science degree here at Caltech. I was a board member of the Student Investment Fund, and for this project, I was in charge of trade execution. Our third member, Hui, was away in China at the time of this filming, but she was able to send us a short introductory clip about herself.
Hi, my name is Hui. I'm a senior at Caltech, majoring in math. I interned with Bank of America Merrill Lynch as a quant analyst last summer. So currently I'm out of the country for winter break, so I won't be able to do the video recording along with my two other teammates, Kevin and Justin.
Our investment philosophy was based off the fact that human nature makes investors fallible. People are constantly talking about the same stocks and ideas, and it is human tendency to feel the need to get in line with the herd. Although some blame the quants for creating a quantitative model which caused the financial crisis of 2008, it seemed that almost everyone was at fault. Despite the fact that some academics had predicted the eventual collapse of the housing bubble, investors were ignoring the warning signs. Money was being made on investments placed in tranches faster than in any other investment vehicles. And thus, investors kept pouring money in as they were afraid of losing out to their competitors. Investors were also biased towards the house view because humans have a predisposition for excitement, and they thought it would be best for their careers to fall in line. People also have a tendency to pay more attention to recent events and look for patterns that might not be there. In addition, people experience asymmetric risk aversion because losing money usually hurts more than making money makes us feel good. Because of all these problems that plague human beings, we decided that we would use a fully automated quantitative strategy of trading so that we could take our own emotions out of the picture. In addition, it is said that it takes an average of several years before it can be determined whether an investor is a lucky fool or actually a good investor. On the other hand, with a quantitative approach, our method can be back-tested because you can control the amount of data that you give to a computer program.
It is well known that in the long run, the stock market rises as a whole. Actually, since 1970, the annual return of S&P 500 has been 10.4%. Here is the graph of the S&P 500 during that time period. We can clearly see that the tech bubble and 2008 financial crisis made a huge impact on the market, but we still managed to get more than 10% return on S&P 500. For each individual stock, beta is defined to be the sensitivity to the market movement. If a stock has a high beta, the correlation between its return and the market return is high. So you would suspect stock with higher beta should come with higher returns. Well, it turns out that's not the case. Here's a scatter plot of stock returns versus beta. We use data from 2010 to 2013 to generate beta and calculate annual return for each stock in 2014. As you can see, there's no clear pattern between the stock return and its beta. Actually, this is nothing new to the academics.
In 1992, Eugene F. Fama and Kenneth R. French discovered that there was a correlation between beta and average stock returns before 1969. However, they also discovered that the relationship actually disappeared after the 1960s, which is when people started studying the correlation between beta and average return. So here's a graph of the monthly returns of the different beta groups, ordered from the lowest betas to the highest beta stocks. As we can see, not only does a higher beta fail to correlate with higher return, but for the higher beta groups, a higher beta seems to be negatively correlated with higher returns. Not surprisingly, the capital asset pricing model was introduced in 1962. And after William Sharpe published a paper on it, it was well known to academics and investors alike. After this, the correlation between beta and average return seemed to disappear completely.
Recently, a paper was published titled Betting Against Beta. It says that a portfolio based on buying stocks in the low beta groups and shorting stocks in the high beta groups will generate a positive abnormal return from 1963 to 2012. Our investment philosophy is based on capturing this inefficiency in the market and using it to boost our returns. Here is another graph of beta versus return, except this time we look at the longer period, which is from 1963 to 2012. Once again, we observe a decrease in average return in the groups of stocks with higher beta. Thus, if we were to take a long position on the low beta stocks and a short position on the high beta stocks, we would generate positive returns even if we made our portfolio dollar neutral and nearly market neutral. We believe that this inefficiency can still be captured because mutual funds are often prohibited from shorting stocks, and most hedge funds have constraints on the leverage they may employ. In order to comply with the rules while maximizing market exposure at the same time, fund managers tend to buy high beta stocks, which drives the prices up. In addition, high beta stocks are volatile, so sometimes they can generate much higher daily returns compared to low beta stocks. Therefore, people buy high beta stocks for the same reason as they buy lotteries. This phenomenon was confirmed by the authors of Betting Against Beta paper. Finally, the beta of a stock tends to converge to 1 as time goes on. So historical beta of greater than 1 is probably an overestimate of the actual beta. Thus, intuitively, the betting against beta strategy has logical economic backing and seems sustainable.
We use the Carhart 4-factor model in order to optimize our portfolio. We use the daily returns from the past 3 years of all the stocks in the stock universe provided by the CQA to generate the sensitivity of each stock to the 4 factors, also known as factor loading. In addition, we used an exponential decay with a half-life of 1 year in order to properly weight the 4 factors.
We used the standard factor risk model to monitor our portfolio risk. We calculated the factor returns covariance matrix and the idiosyncratic returns covariance matrix and combined them with the long-term moving average. So now we have all the factor loadings and the risk measures, we can move to the optimization phase. Basically, we try to minimize our beta exposure and the volatility at the same time and choose parameter lambda to maximize the Sharpe ratio. Traditionally, people will maximize exposure to other factors to take advantage of the size premium and the value premium. But in fact, for the past 12 months, size premium is negative 7.8%, while value premium is negative 1.9%. So it's dangerous to take directional view on the factor returns. Instead of maximizing the factor loadings, we limit our exposure to the other factors in the Carhart 4-factor model. Moreover, our maximum position size for each stock and the overall net position is limited to be less than 2%, as having a more diversified portfolio would also help to maximize the Sharpe ratio and prevent big losses from events that cannot be foreseen.
After running our optimization, we also verified that our portfolio was well diversified, which would help encourage steady growth and minimize volatility.
In the original Betting Against Beta paper, the authors tested the strategy with the long-short equity portfolio. They buy low beta stocks and short high beta stocks and maintain net long position and neutralize beta exposure. They did their test from 1926 to 2012, which is almost 90 years, and the results, as you can see, are quite amazing. The annual excess return is more than 8%, and even we take out the contribution of Pharma French Carhart 4 factors, there's still 6.6 abnormal positive return left, which is also known as alpha. The Sharpe ratio for this 86-year period is 0.78. For comparison, the Sharpe ratio of all mutual funds is 0.37 for the past 30 years. So the Betting Against Beta strategy realizes a Sharpe ratio twice as much as the Sharpe ratio of most mutual fund managers.
After constructing a portfolio based on these constraints, using data from before November 2013, we backtested our strategy against the actual returns in the last year. Our initial portfolio had a beta of around negative 0.27 with minimal exposure to the Carhart 4 factors. We proceeded to plot our portfolio's performance against the S&P 500 over the past year. We observed that our portfolio seemed to perform best when the market was in a down period. This made sense because we have a negative beta value. However, we were still able to generate positive returns, which was not predicted by our negative beta. This was evidence that betting against beta by taking a long position in low beta stocks and shorting high beta stocks was a viable strategy. So here's a breakdown of our return, volatility, and Sharpe ratio compared to the S&P 500 over the previous year. Although our portfolio did not outperform the S&P 500, it was far less volatile, which contributed to a Sharpe ratio of over 2. Our downside deviation and maximum drawdown percentage were around half of that of the S&P 500. The 4-factor alpha from the Fama-French model contributed to 11.74% of our portfolio returns. Over the long run, we would expect our portfolio to generate around 6 to 7% annually, with a much lower volatility and risk than the stock market. We expect around a 6 to 8% annualized volatility, which is around half of that of the stock market.
Thus, we went ahead and used the same algorithm with additional data from previous year to generate another portfolio based on the betting against beta strategy. All our positions were about 2% of the total value of our portfolio. We took one more long position than short position in order to keep from betting against the market with a more negative beta. Overall, our portfolio beta came out to be negative 0.27 as before. Here is the return of our portfolio versus the S&P 500 since the beginning of this competition. We seem to be performing around the level of the S&P 500 by taking advantage of the betting against beta method. Moreover, when the market dropped in the first half of December, our portfolio continued to rise at a steady rate. Thus, our predictions with the portfolio volatility and the steady returns were validated.
As of December 16th, our portfolio had a total return of 2.66%, with the majority of the profits coming from our short positions. In addition, because we invested slightly over the $10 million limit, we also have been paying interest, which is negligible compared to the size of our portfolio and our expected returns. From the first 36 days of the competition, we had an alpha of 1.80%, which contributed to 67.4% of our returns. Since we have a negative beta and the S&P 500 had a negative return over this period, our portfolio beta accounts for around $86,000 of our return. We limited exposure of the 4 factors, so this should have a very small effect on our return. Thus, the rest of our profit was generated by our strategy, which contributed to the 1.80% alpha return.
To summarize, betting against the beta strategy is 100% quantitative and fully automated. The risk and the downside risk are very small because we control the exposure to the market movement and the other factor returns. It's supposed to be an all-weather strategy by construction, which can also be validated from our multiple tests.
We would like to thank the Chicago Quantitative Alliance for offering this challenge. This gave us a fun and exciting opportunity to learn about the stock market and different quantitative methods for investing.
We would also like to thank Professor Ken Winston for mentoring us through the whole competition and for guiding us in learning more about the stock market. Thank you for listening to our pitch.